Hello, PI listeners. This is Ryan McKenna, and we're on the Passive Investor Show.
Are you a busy professional looking to diversify your portfolio? Ever wanted to passively invest in real estate but don't know where to start? John Fortes provides you with a guide to passively invest in real estate. This is the Passive Investor Show.
And now, the Passive Investor Show. Here's your host, John Fortes.
Hello, PI listeners. Thank you for lending me your time today. Welcome to the Passive Investor Show. I'm John Fortes. Our goal is to provide you, the busy professional, with passive investing tips and tricks for your real estate investments to leverage more time for you to focus on your true passions. Let's get to work. Today, my guest is Ryan McKenna. Ryan McKenna is a full-time real estate investor and founder of McKenna Capital, a private equity firm that provides opportunities for investors to become passive equity partners in institutional quality, recession-resilient real estate. Focusing on value-add multifamily, self-storage, and manufactured home parks, McKenna Capital has helped investors allocate capital across 7,500 units with a combined asset value of over $750 million. Wow, Ryan, that's impressive. Thank you for coming on to the show today. I'm grateful to have you.
Thanks, John. Happy to be on here as well.
I appreciate you. Tell me more about your background and how you got into it.
So I first learned of apartment syndication back in the early 2000s when I was playing baseball at Arizona State. One of my teammates, his father, was an apartment syndicator, and I was always curious what he was doing when he'd come into town and be looking at these big apartment complexes. And so one day I got talking to him, and I just thought it was pretty neat to be able to pool together a bunch of investors, which is how I learned what a syndication was, and then to really buy these big apartment complexes. So I think at an early age, I knew what apartment syndication was, but I never really got into it until several years ago when I first started having some capital. But I also around that time had learned about the book Rich Dad Poor Dad by Robert Kiyosaki. So that was like my blueprint for passive investing in real estate syndications. And so I always knew that this was something I wanted to do. It was just a matter of getting that first opportunity and then really laying out the strategy to have it be a full-fledged, passive investing income stream for me.
That's pretty cool. I got one question though. What position did you play? And was that your natural position?
I was a center fielder, and that was my natural position. I'd love to go, shag down those fly balls and just dive out there, get a little dirty. It was a fun time.
Mr. Go Get It. I see it. And that translates to what you're doing right now with passive investment. You go and get it. You actually contribute into these deals and put your investors into these deals as well, too. Tell me about your first opportunity.
So my first opportunity was actually with the teammate of mine, his father, who had the apartment syndication business. He became like a mentor to me over the years. And then when I first had some capital, I reached back out to him and invested in a deal with them. Actually, it was in Dallas. And from there on out, I did 4 more passive investing deals with him. And it was just a great way for me to diversify. I was investing in a deal in Minneapolis, Portland, a couple in Texas, one in Phoenix. So really quickly, I was realizing like, wow, I'm taking positions in different real estate assets in different states that I just didn't, if I look at it from the active investing route, it just would be overwhelming to try to kind of cover that many markets. And so here I was, literally building my own real estate private equity portfolio just by tapping into people I knew that were in the business and that I trusted. And so that really kind of kicked things off for me. And then from there on out, I invested in many more syndications with different sponsors in different markets. And I was really trying to kind of learn and understand the business. But that's really how I got started. That first deal was with someone that I had known for a while and who I trusted, and to this date, still investing with.
So let me just ask you, if you was to just learn about this passive investing strategy and you became a little bit interested. How would you go about, vetting an operator today? Like, say there wasn't a company like yours that knows these operators and has these relationships, how would you start?
So if I was a new investor kind of looking to do my due diligence on a sponsor, you can find a lot online just by researching the company, but I'd also, definitely would want to have a conversation, or at least, see what it would be like if, they were to give me some time to answer some of my questions, and then just try to understand their communication style and how they work with investors. But I think before that too, just anything regarding their track record and experience, I think is a good starting point, because you can kind of vet out someone who has maybe a long track record, has been through a downturn, or someone that's newer, that's just starting out. And so I think, I wouldn't say one is better than the other, but for personal preference, you might, lean towards one or the other. And so I just think kind of having that starting point, and then also like just the opportunity to really, if there's anyone else that that maybe has invested with them, or if there's a referral in the industry, it's always good to get some outside input, not just, what they're telling you, but also try to verify it in some way. So sometimes you can do that with other investors. And that's how a lot of people get into deals, is they hear about it from someone who has had a good experience. So a lot of this comes down to relationships. And if you don't have one, I would try to find a way to build one with a sponsor or two out there, just so you can get closer and ask your questions and get that comfort level that, you're going to need at some point to pull the trigger and actively do something with them. But beyond that, I mean, that's just kind of on a surface level answer, how I would kind of dig into it. And then also looking at what markets they're focused in on, and what is their strategy, and what are their projected returns that they're delivering to investors. And so that these are questions, I think, getting more into, a particular deal. But I think on the front end, you want to just make sure that, whoever you're talking with is someone that you believe has, great integrity, high character, and that someone you can trust, because ultimately you're going to be putting your money into their business plan, and you're going to be betting on them to execute on that.
Absolutely. I would actually add getting on their list and seeing how the process comes out, saying, here's the offering, and jump on this call for more questions and stuff. So just getting involved in those type of scenarios, so you can get comfort in those situations as well, because, there's a timeline on those where funds can get filled up pretty quickly, and we all know that. And, we got to have that trust to be able to, like, here's this 100K, there you go. So
yeah, that's a great point. Definitely, it's a way to just get educated, to look at the deals that they're doing or the deals they've done in the past. So there's not a situation where there is that shortened, time frame where you got to jump in. It's like, if you can do that on the front end, you'll be more comfortable. So that when that opportunity does come, that might have a short, time frame associated with it, then you're going to be in a position to act on it if it fits what you're looking for.
Absolutely. There's numerous of deals where it's probably you provide capital and you say, I'm in, and then they turn you away because it's filled so fast. So that's just part of the process, because there's so many passive investors that are trying to get into these deals, and you want to get in a few of them as well. So it's up to you to kind of get involved and get past that analysis by paralysis, or paralysis by analysis. I always butcher it, but you know what I mean. So what kind of impact has this had on you and your passive investing career?
So, I mean, this has completely changed my life, being a passive investor in real estate syndications. It's kind of a different path. I mean, I think most investors that try to get into real estate do an active route, which, can be passive, but for the most part, I mean, I went down that path of investing in single family rentals, and just, it wasn't passive to me. It was very active, and I learned the business, but I also learned that it wasn't something I could scale and that I really wanted to do long-term. And then when I got into multifamily syndications, it was a complete game changer for me. I felt so much more confident putting my capital with someone who had a great track record, who had done deals over and over again, and had just that expertise that I didn't have. And so, and it was really cool to be part of owning a 300 unit apartment complex in say Portland or Minneapolis. I mean, that was really neat. And so, after investing deal after deal after deal, the nice thing about the way these deals are laid out is that you get cash flow distributions from investing in the deal, but then you also get the equity, or the forced appreciation that happens as the renovation plan starts out, and then along the way there's ways to get equity back through cash out refis, or eventually when you sell. So as an investor, I mean, building out this passive income in a very diversified portfolio across 15 different markets and over 25 different deals, it feels good knowing that your capital is going to work for you, whether you're out on vacation, sleeping, doing something else. I mean, that money comes in pretty much like clockwork. And I really like the reliability and the consistency of the cash flow streams. And then also the resiliency a lot of these assets have in a downturn that makes me, feel comfortable about, the preservation of wealth. I mean, a lot of investors are putting their hard-earned capital into these types of deals, and you want to know, what is, the risk associated with it. And I think it's comforting to know that a lot of these assets perform very well in a downturn. And another thing I really didn't fully appreciate until after the first year of investing in a lot of these deals was the tax benefits. And that is something that I think it makes these deals, what I would already say are already some of the best out there, from the return profile you're looking at, the cash flow end of it, and then also the equity that long-term generational wealth you can create. But it's the passive, it's the tax benefits that really, I think, separate a lot of these deals, because I don't know many out there where you can get a really nice, consistent passive income stream and not pay taxes on it, and then eventually someday, maybe pay taxes. But then there's other strategies like a 1031 exchange, or you might have other investments that could offset some of your gains. And so that whole part is a whole nother strategy, just even inside of investing in these deals. And so I just look at like the ability to get your capital to work and have it working, at a maximum capacity where you're not having to pay taxes year after year, which then reduces, your future investments. So as a passive investor, it's allowed me to free up a lot of my time with my family and friends. And that was really my reason for wanting to put enough capital to work so that I could then step away from work, which is what I did about 5 months ago, and got into this full time. And it was over about a 3-year period where I put a lot of capital into these real estate syndications and let the capital go to work with the experienced operating partners. And then eventually I had enough cash flow coming in to cover my expenses, and I was getting really burned out a little bit with my current job. And so this was a great way for me to give myself that freedom and that financial independence, which, at this point, there's no looking back. I've got it set in motion, and it just continues to keep growing and growing. And I continue to keep investing, and it's just something I absolutely love and I'm very passionate about.
That's pretty cool. First of all, congratulations on achieving that, because working that hard for 3 years to get to this point, that's pretty phenomenal. I appreciate that, and thank you, and congratulations.
Oh, thank you. Yeah. And it happened quickly, but it was 15, 20 years of me in the business world of working and building. And I had some other businesses too that were taking up some capital, but I eventually diverted when I saw a path, I saw an opportunity. I took everything that I had and just started putting it into these types of deals. And so, you don't have to wait, your entire life before you get in one. You can start small and start building it from there. But I kind of, when I saw the strategy, I saw the opportunity, I went all in, and I basically, decided that I could do it passively, investing in syndications versus wanting to own a bunch of homes or being more actively involved, because that's hard to do when you have a full-time job, to then, step in and try to manage a property that you're doing part-time. And I'm looking at some of these professionally managed firms. That's all they do. I mean, they're going to have a leg up on managing that asset and do a much better job than I could. And again, I just could really only do that in my backyard versus, investing in some great markets, throughout the country that I was just getting access to.
Absolutely. What would you have to say to a passive investor who wants to sit on the sideline because they're foreseeing an incumbent downturn? How do you feel? What do you say to that type of a person?
So I hear that a lot, especially now, kind of where we're at in the market, the economy. And, I understand that everyone kind of looks at things differently, and everyone has their own, comfort level with these types of investments or investing in general. The way I look at it is as a passive investor, I mean, I have options, right? I could invest in these types of multifamily syndications. I can, put my money in the stock market. I could, keep it in savings. And the way I look at it, the stock market, it's very volatile, especially right now. I know at any point in time, I could lose 20, 30% on my investments or my net worth. And that's not going to feel good if that happens. And for me to recover from that, I basically have to double that loss to just get back to even. And that's really, really difficult to do, especially long-term and to try to time the market. So I don't like to put a lot of my capital in the stock market for that very reason. And the returns I earn in real estate are much higher than that anyways. And I don't have the volatility. I have a lot of the consistency and the reliability of the passive income streams. And then with the savings, it's like if I leave my money there, over time, inflation is going to, ruin my returns, and I'm going to, lose out there. So I don't look at that as a great plan. Even though it's very hard to time a market, I look at even where we're at today, and the targets that we're shooting for in a lot of the deals we're doing are in that 16 to 20% range. And so with my capital spread out amongst many different markets, many different sponsors, and even different asset classes, I'm just looking for a blended return of 16%. And that's something that I think is very conservative, and it helps me sleep well at night because I know it's not like I have all my eggs in one basket or all my money in one deal. And I know I'm going to have a lot that are going to perform a lot better than the 16%. And maybe there's some that come in right around there. And if I have one that misses, in a market like this, if we go through a recession, and a miss in the world of what we're looking at is generally in the 8 to 12% range. And when you put that in perspective of other opportunities out there, the potential to lose 20 to 30% in the stock market, if I'm in a deal where I might only make 8 to 12% and I get all these tax benefits, it's a no-brainer to me. And so I'm not trying to time the market. I'm just being very disciplined. You want to find a good deal. You want to make sure it's conservatively underwritten, but I'm not sitting on the sidelines right now. I mean, I have my capital to, put to work, but I also, will save a little bit just in case, I need it. But generally speaking, to me, I've not seen an investment that's still, is performing at the level that it has, and has, great resiliency in a downturn as well. I mean, you could look at it from the flip side of, a lot of the apartments we invest in that are, in the affordable housing, class B range, could even create more demand from a renter standpoint, because you got class A investors that might want to move to class B, and you got a lot of class B investors that this is already affordable housing for them and they need a roof over their head. So you might not necessarily be able to exit at top dollar in a downturn, but if you got the cash flow, which is a great benefit of being in these deals, you can ride it out and then sell when it makes sense. And so the flexibility around this type of investment is also very appealing. So I'm not locked into, we got to get out of the deal or we got to sell now. We ride it out as cash flow investors. And that's kind of the beauty of having the control of the cash flow in a large deal like this.
That's cool, man. Ryan, what's one piece of advice you can offer for the PI listeners?
So for the PI listeners, I would say if you want to get into this type of investment, if you want to you kind of have a stake in the real estate game, go emulate someone else out there that's doing what you're doing. I mean, there's so many people out there that are just providing great content that are, out there willing to help someone who wants to get involved. Just go, align yourself with someone who's doing what you want to do and start asking questions and try to, get curious about how they did it, because I think that's the best way to learn. That's how I learned. I saw so many people putting their capital to work, making really good money, investing in these syndications. And at some point I said, I'm not going to wait on the sidelines and watch everyone else do it. I'm going to do it. And I did it. And it feels really good. And I think a lot of times, you can kind of sit back and wait. And then, time passes and then all of a sudden you get busy or you're looking at something else and then you just miss an opportunity. And so I'd much rather, take the opportunity. And if I make a mistake, I learn from it. But Wayne Gretzky had a great quote that I live by, and it's you miss 100% of the shots you don't take. And so you never take a shot, you'll never know. And, you got to obviously do your due diligence and everything, but I'm a big believer in a lot of life is just taking action, and then, you learn on the job sometimes, but for the most part, you'll never know if you don't try.
I appreciate that. There's another thing I wanted to hit on is with you and your investments in your deals right now, you are seeing some capital come back to you in the form of a refinance. And just explain the process of that. When you receive the refinance, that enables you to go ahead and go in another deal. But tell us about the benefits of the previous deal the capital just came from.
Yeah, and that's a really powerful mechanism in these types of deals where you can kind of reload with current investment dollars into another deal. So I'll give you a perfect example. A deal I invested in about a year and a half ago. They went through, we're ahead of schedule, did a cash out refi. I got 84% of my capital back in that deal. And then with the cash flow, I mean, I almost had 100% back early on. And I got the cash out refi, which is 100% tax free. So that money came back to me. I took it and I invested in another deal, and had that money going to work for me. And I still maintained my equity position in my original deal. So it basically, planted one seed initially, and it turned into another one. Now I've got two trees growing with cash flow spinning off, and then eventually that first deal will sell, and I'll get even more capital back, and then I'll invest in a third deal, and then that second deal I invested in will likely go through a cash out refi, and then I'll repeat the process again on a fourth deal. And that's really where it gets fun, this type of investing over time, because it starts to snowball, and it takes a few years of you making those investments and being disciplined, and getting 8% on your money, I think is great. It might be minimal to some, but when you get that cash flow, I mean, that adds up over time. And that 8%, if you do look at it from a tax perspective of what it would cost you to actually net the 8%, and you're talking about like 11 or 12% return on your money that is just coming out of the deal. I mean, that alone it's a great investment, even without the equity piece. And the equity piece could easily be double that. So it's just, it's great from the standpoint of, again, the cash flow streams, and then how you're able to quickly, compound your returns when you're able to reinvest in a cash out refi. And a lot of times I see right around the 2-year mark is typically when that will happen. And it's also a time too that the operating partner might look to unload the property, because it's a very attractive acquisition for a REIT who wants to come in and buy something that's turnkey, and they want to just kind of coupon clip that cash flow. So you as an operator have great flexibility in like returning capital through a cash out refi, or potentially maybe selling the deal if the numbers are way better than the pro forma and you're ahead of schedule and you get that attractive offer. So that's the fun part of you're planning for a 5-year hold, but as an investor, I might have 50% of my capital back halfway through a 5-year hold. Now, the example I mentioned before is pretty extreme from a cash out refi, but generally what I see is between the 20 to 40% range. And if you couple that with 2 years of, that 8% cash flow, you're like 50% of your investment back, 2.5 years in. And I don't know many investments where you get, your capital back that quick. On the flip side, I've done other deals in other sectors. I've done some angel investing, and I might have to wait 7 or 8 years to find out if I'm going to make any money. I get no cash flow along the way. It's all back end, and 90% of the deals, I'm going to lose all my money within the first 2 years. And so I look at this as like, yes, I do some of that, and it's more risky, but there's smaller allocation that goes to it. But for what I do on a day-in-and-day basis, I mean, to get 16 to 20% to basically double your money in 5 years, and to have the cash flow stream that allow me to live the lifestyle I want, to cover all my expenses. It just, for me, it's a no-brainer. And then the tax benefits I mentioned earlier are just phenomenal, and I don't think are truly appreciated until you actually go through and you get your K-1s and you see the paper loss. And it's pretty fascinating. And I know that the government rewards producers out there, and contributing to an investment in an apartment complex is only stimulating the economy and the community. And that's really important. And that feels good being a part of all this too, because not only are we making money, but we're making an impact and a difference in that community. And this is housing for people that want a nice place to live. And so I don't ever see some of those benefits going away because of the importance of this type of, capital that's needed to really, make some of these communities just a better place to live.
Really powerful, and the way you just provided color on that, it's you can see, well, actually you can hear in this instance, the path to generational wealth. So it's very powerful. Thank you for explaining that. Ryan, how can we reach you?
So the easiest way is just to go to my website, McKennaCapital.com. I have a lot of information on there. I write blogs. I try to share educational content. You can sign up for our investor distribution list there to be kept in the loop on what we're working on. I'm on all the social sites, but you can actually get all that through my website, McKennaCapital.com.
One-stop shop. I love it. Ryan, first of all, I just wanted to tell, we were able to share a couple panels this year, and it was kind of cool, and be in the same room with each other. And it was a pleasure. And the one thing that I will take away, it's not the panels, it's the airport conversation we had for the final 20 minutes that we were around each other. It was, let me just paint the picture. Me and Ryan, I kept saying, Ryan, we got to talk. And we couldn't link up at these events. And we walking. Well, I got to the airport before you, and then I went to go grab a drink, and I see Ryan walking, and we finally had that final conversation that I've been meaning to have with you, and it was pretty good. It was really good, just sharing thoughts and ideas on what we're doing and experience in the industry, and we all rise with the tide, right? So that was basically the conversation. I just wanted to show my appreciation for that.
No, thanks, John. It was great. And I look at the more that we all can do together, the bigger the pie grows, because there's still 99% of the population out there that just doesn't know about these opportunities. And I think we all work together to help educate investors, to create awareness. We're only going to impact the lives of others out there and ourselves along the way. And I just think it's a really cool real estate ecosystem to be part of. And everyone that I've interacted with has always been very giving of their time and knowledge. And I'm just trying to do the same. And so I'm glad we were able to have that conversation and continue to keep having conversations like that, because this is what it's all about. It's one big partnership. We're all in this together. We're all investing a smaller piece into a bigger asset, and we're all along for the ride together.
I appreciate you. Thank you for your time today, Ryan.
Yeah. Thank you, John. Thanks for having me on.
No worries. Anytime, man. Anytime. PI listeners, I appreciate you for listening. If any of this resonates with you, please subscribe and leave a review. The more you know, the more we grow. Thank you for tuning in. Till next time.